webinar, Developments in Dealmaking and Proposed Regulation Changes and the Impact on M&A Activity. This webinar is presented to you in partnership with Alvarez & Marsal, Taxand LLC, and Smith Amundsen LLC. You can use the Q&A feature at the bottom of your GoToWebinar toolbar to ask questions. These questions will be monitored by our presenters. This webinar is being recorded and will be posted in acj.org's webinar library, along with the slides from today's presentation. Thank you again for joining us. And now I will turn it over to Eric Fogel, Partner and Executive Committee Member and the Chair of the Corporate Security Practice Group with Smith Amundsen LLC.
Good afternoon and welcome. My name is Eric Fogel with the law firm of Smith Amundsen. The topic today is recent developments in deal making with an emphasis on tax issues, structure issues, and regulatory changes. I'm going to talk about 4 issues that come up frequently in M&A deal making: purchase price allocation, tax return audit risk, Section 338 elections, and tax credit and refund allocations. First, I'd like to talk about purchase price allocations. Why is this important? Purchase price allocation is implicated in connection with transactions, tax, and sales of assets. Purchase price allocation is not needed for stock transactions unless a Section 338 election is made. We will discuss Section 338 elections in further detail later. Buyer and seller often have conflicting motivations when making tax and business structuring decisions. When an acquisition is taxed as a sale of assets, the buyer wants to recover the purchase price through allowable expense deductions as quickly as possible. The seller wants the lowest tax bill possible. As a result of differing tax rates, as well as differing amortization and depreciation periods based on the asset class, the buyer's and seller's purchase price allocation preferences may not always be aligned. Practically speaking, there are a few key circumstances where a purchase price allocation question becomes a substantive issue in an M&A deal. First, allocating purchase price among various asset classes, and secondly, in the special case of a sale of assets of a C corporation, attempting to segregate out the personal goodwill of a key principal in order to avoid significant taxable gain at the corporate level. From a regulatory standpoint, there is not much flexibility with respect to purchase price allocation among asset classes. Under Section 1060 of the Internal Revenue Code, purchase price must be allocated to the assets under the residual method. This means that the purchase price is allocated as follows. First, Class 1 assets, cash and cash equivalents, then Class 2 assets, actively traded personal property, next Class 3 assets, accounts receivable, mortgages, and credit card receivables, Class 4 assets, inventory, Class 5 assets, basically equipment, land, and building, Class 6 assets, customer-based intangibles, so-called Section 197 assets, and finally, the remaining portion, the residual, allocated to Class 7 assets, which are seller self-created intangibles such as goodwill and going concern value. The tax rules follow strict allocation guidelines in order that tax benefits, such as expense deductions, may not be unfairly shifted or accelerated in the context of the sale of assets. The seller would prefer to have purchase price heavily allocated to capital items to incur capital gains treatment as opposed to ordinary income treatment. The buyer prefers to have purchase price allocated to ordinary expense items or quickly depreciable assets such as equipment, which in many cases can be depreciated in 5 to 7 years, and in some cases as short as 3 years. The worst case for the buyer is a large allocation to goodwill, which the IRS rules require depreciation over a 15-year period, a very long time. The tax rules step in and provide guidance for the amounts that may be allocated to assets in each class. A typical issue in an M&A deal is the allocation between property, plant, and equipment on the one hand versus goodwill. property, plant, and equipment can be depreciated over a shorter period of time than goodwill, which means the buyer would like as much purchase price as possible allocated to property, plant, and equipment. A larger amount allocated to property, plant, and equipment would provide the buyer with an accelerated cost recovery mechanism. The tax rules require that an amount equal to property, plant, and equipment's fair market value be allocated to this asset class, and thus any ability to manipulate tax consequences is relatively limited. So the takeaway point is that when dealing with a transaction taxed as a sale and purchase of assets, the buyer will want to allocate as much purchase price as possible to assets that may be depreciated or amortized more quickly than goodwill and Section 197 intangibles, generally 15 years. The seller just wants to allocate as much purchase price as possible to assets that provide for advantageous tax treatment. That is, capital assets such as property, plant, and equipment, and goodwill, rather than ordinary income assets. The value of intangibles such as goodwill is not always easy to quantify and is therefore an area where tax and valuation considerations can be especially important. Buyers typically do not want a high value assigned to goodwill due to the extended depreciation period. And then there's the valuation issues associated with inventory, with adjustments for obsolete and damaged inventory. A buyer will typically want a good valuation of property, plant, and equipment in inventory to justify the purchase price allocation. To reduce goodwill, a buyer might negotiate some sort of consulting agreement with the seller. The purchase price would be reduced to take into account the future payments to the seller under the consulting agreement. The reduced price would mean less value to allocate to goodwill. When this approach is taken, it is essential for the consideration under the consulting agreement and the purchase price to both reflect actual fair market value. Otherwise, the IRS could reallocate amounts between the consulting agreement and the sales contract. In contrast, from the seller's perspective, a consulting agreement is less desirable than an allocation of purchase price to goodwill, as the consulting agreement generates ordinary income, albeit with some deferral of income recognition. Non-compete contracts have undesirable tax consequences to both parties, ordinary income for the seller and a 15-year recovery period for the buyer. I will next discuss the prospect of a key principal sale of personal goodwill in connection with an M&A transaction as a strategy to benefit the seller. Personal goodwill exists when a shareholder's reputation, expertise, or contacts contribute significantly to the company's value and future income stream. Personal goodwill can be manifested in the close personal relationships that exist between certain shareholders and key decision makers of customers or suppliers. It is most likely to be associated with businesses that are technical, specialized, service-oriented, or professional in nature, or have a few customers and suppliers. If personal goodwill is treated as property that can be sold in conjunction with the company's assets or stock, it can produce a favorable tax result for both the buyer and the seller. Personal goodwill can be sold as an outside asset in merger and acquisition transactions pursuant to a separate contract. This allows the selling entity to avoid corporate-level taxation, as in the case of a C corporation, with respect to the portion of the overall transaction consideration apportioned to personal goodwill. For the buyer in a transaction taxed as a purchase of stock, where there is no 338 election, the buyer would have acquired an amortizable asset, which would allow a cost recovery benefit, albeit extended over a 15-year period. I will next talk about tax return and audit risk. Why is tax return audit risk an important issue in connection with merger and acquisition transactions? An audited business can incur substantial penalties and fines in the event the IRS discovers improprieties in its prior tax returns. This is especially relevant in connection with stock purchase transactions, as the liabilities, including contingent liabilities associated with tax audits, would remain with the acquired company. Under certain circumstances, a transaction structured as an asset deal may also expose the buyer to tax audit risk. Typically, all risk of audit related to pre-sale operations will be borne by the seller, at least for a specified survival period. This concept will typically be handled through the identification of such liabilities as excluded liabilities in connection with an asset deal and in any transaction under the indemnity provisions. In any acquisition, the selling shareholders or company, as applicable, will provide indemnity for the negative consequences of a tax audit. And in an asset deal, the tax obligations will be excluded from the purchase and sale of the assets. Buyer will want the indemnity period to be as long as possible, typically to last until the end of the statute of limitations for audits under the IRS's rules and regulations. The seller obviously prefers the indemnity period to be as short as possible. More recently, buyers in M&A deals are demanding that tax indemnities be outside the general indemnity and holdback against the purchase price. In fact, some buyers require special indemnity funds to be established to cover liabilities such as tax audit risk or transfer tax issues. Generally, the statute of limitations for tax return audits is 3 years. For example, the IRS would have until April 2018 to assess additional tax on a business that files a 2014 return in 2015. However, the IRS can reach back 6 years if a business erroneously fails to report more than 25% of its gross income. Furthermore, the IRS can audit as far back as necessary to address tax fraud or when businesses completely fail to file tax returns. Let's talk about the likelihood of audit. The following are audit rates for small businesses. For small C corporations with total assets of less than $10 million, they faced an audit rate over the last few years of only 1%. Those with assets between $1 million and $5 million were audited at a 1.2% rate. Those with assets between $5 and $10 million faced a 1.9% rate. Middle-sized C corporations with assets between $10 million and $50 million were audited at a 6.2% clip. A business has a good chance of being almost totally off the IRS radar if it is operated as an S corporation, partnership, or multi-member LLC, rather than as a sole proprietorship or a regular C corporation. The audit rate for both S corporations and entities taxed as partnerships has been very low over the last few years, at about 0.4%. There are, however, a few matters that may increase the likelihood of audit for S corporations. S corporations that pay their owners no salary or an unreasonably low salary will attract the IRS's attention. Many taxpayers try to avoid or minimize self-employment taxes by setting up an S corporation for their business. The IRS is actively looking for shareholder employees who take salaries that are too low. Instead of taking a salary, the shareholders take profit distributions from their company and avoid self-employment tax on those distributions. If the company has large profits or low or no officer salary, then the company is opening itself up for an audit. Buyers of S corporations should analyze this issue closely. The IRS is also on the lookout for companies that pay their employees as independent contractors. It is very common for businesses to treat their workers as independent contractors, when they should, in fact, be paid as an employee. The business saves money by not having to pay the matching payroll taxes and not having to pay benefits. Simply having a large number of independent contractors on the business tax return may flag the company for an audit. States frequently audit this issue because when a business has independent contractors rather than employees, it avoids paying state payroll taxes like unemployment and disability insurance. If the state finds that a business has misclassified its workers as independent contractors, it will often notify the IRS of violation, which can lead to a federal audit. Next, I will talk about Section 338 elections. What are 338 elections and why are they important? These elections are generally advantageous for buyers. How? Section 338 permits a corporation that makes a qualified stock purchase of another corporation to elect to treat such acquisition as an asset acquisition rather than as a share acquisition for federal tax purposes. What's the general impact? The tax basis of the assets held by the target company is stepped up to the purchase price. The step up in basis allows greater deductions for appreciation and amortization. For instance, if the adjusted basis of assets in the target corporation is less than fair market value, Section 338 would allow the adjusted basis to be increased to the fair market value, resulting in a larger value available for depreciation by the buyer, and thus for larger annual expense deductions, which would reduce taxable income. There are two types of Section 338 elections. The first being Section 338G, used in case of foreign acquisitions, and then Section 338H10, commonly used in the case of domestic acquisitions. Both types of 338 elections require a purchaser to acquire 80% of the vote and value of the target company stock. With respect to Section 338G, by treating the stock sale as a sale of assets for tax purposes, the target corporation is deemed to have sold its assets, and therefore gain becomes recognized at the target company level. In addition, the seller recognizes gain or loss on the sale of target company shares. Accordingly, the Section 338G election results in two tiers of tax and thus generally is not beneficial in the case of a domestic acquisition, since the acquirer pays tax on the gain immediately and realizes the benefit of the stepped-up basis over time. However, such an election is beneficial in the case of an acquisition of a foreign target. A deemed sale of a foreign corporation without U.S. operations has no U.S. tax impact, as the foreign corporation is not subject to U.S. tax. Assets of a foreign target would be stepped up for U.S. tax purposes, which would result in lower future taxable earnings and profits due to higher depreciation and amortization. This is why, in part, U.S. companies love to acquire foreign corporations. Now, under Section 338H10, the target must be a corporation that is either a subsidiary that filed with a consolidated group, a corporation that is 80% controlled without filing consolidated, or an S corporation. In addition, both parties must agree to the election, and a joint tax report must be completed. Both the buyer and seller need to complete Form 8594. With the Section 338H10 election, the results will depend on whether the target company is taxed as a C or an S corporation. In either situation, the benefit to the buyer is that the acquiring company will own a new subsidiary with a stepped-up basis in its assets. For a C corporation, in a stock sale, the target company is required to recognize income as if it liquidated all of its assets in exchange for the purchase consideration, and the shareholders are taxed upon a hypothetical distribution of the proceeds. Thus, two levels of tax are incurred. Typically, the buyer will agree to indemnify the selling shareholders for any negative tax consequences occasioned by the Section 338H10 election. For S corporations, assuming the target corporation does not have built-in gains subject to corporate level tax under Section 1374, the 338H10 election results in the selling shareholders paying a single level of tax on the sale, because any S gain on the deemed asset sale would flow through and be taxed to the shareholders under the normal Subchapter S rules. I will now talk about tax credit and refund allocations. Tax credits and refunds are off-balance sheet assets that may provide additional value in connection with a merger or acquisition transaction. The buyer would like to get any such benefits for little or no additional consideration, and the seller would like to use any such assets for leverage or increasing the purchase price. During the buyer's acquisition due diligence phase, much effort is generally spent on evaluating understated or unreported balance sheet liabilities, overstated revenues, and/or understated expenses. Less time is generally spent focusing on overstated expenses and unreported assets. The main reason for this lack of focus on unrecorded assets and overstated expenses is the fact that the vast majority of price formulas in M&A transactions are tied to EBITDA and the balance sheet as of the date of closing. Therefore, if the purchaser identifies unrecorded asset balances or decreases in expenses, it may actually drive up the cost of the target business. Conversely, if a purchaser decreases asset balances or increases liabilities on the closing balance sheet, or if EBITDA is decreased, the purchase price of the transaction will also generally decrease. Unrecorded tax items will not generally impact EBITDA, but can be factored into the purchase price negotiations to the advantage of either the buyer or the seller, depending upon the nature of the item and which party first identifies the unrecorded assets. Typical tax items that can generate closing balance sheet assets and also improve the annual after-tax profits include the federal and state research development credits, IRC Section 41, state and local sales tax exemptions and credits, local property tax exemptions and credits, federal and state energy tax credits, IRC Section 48, federal empowerment zone hiring tax credits, IRC Section 1396, and federal renewal community zone hiring tax credits, IRC Section 1400H. Since most of the benefits can be claimed for 3 or more prior years via amended returns, and the credits can generally be carried over to future years, subject to IRC Section 383, the magnitude of these benefits and the impact on the purchase price can be significant. Therefore, the purchaser should have a list of similar items to evaluate as part of their due diligence process. Once either the buyer or seller has quantified these benefits, this information can be used as follows. Let's talk about the seller's negotiating advantage. To the extent the buyer identifies these overlooked or underreported benefits, the buyer can factor benefits into the sales structure, for example, stock sale, asset sale, etc. If the target business is an S-Corp, LLC, partnership, or disregarded entity, the aforementioned credits will generally have flowed out to the individual equity holders, and there will be no pre-acquisition refund potential at the target company level. However, the seller can point out the future benefits to the buyer at a strategic time in the negotiations in order to enhance the value of the business and purchase price. The sooner these benefits are quantified, the better chance the seller can maximize an upward adjustment in the company value. The increase in the target company's valuation can be associated with prior year refunds as well as enhanced future profitability associated with the newly quantified benefits. If the target company is a C Corp, the seller will often want to sell stock in order to minimize double taxation and maximize the allocation to capital gain income. These additional pre-acquisition refunds may make a stock purchase more appealing to the buyer because a stock purchase will generally be required in order to allow the buyer to obtain the prior year refunds. If an asset sale structure is required to achieve overall tax efficiencies, to deal with regulatory issues or just general preferences of the buyer and the seller can simply file for the pre-acquisition refunds after the sale has been completed and retain the refunds, provided there are no provisions in the purchase agreement that would allocate such refunds to the buyer. Now let's talk about the buyer's negotiating advantage. Buyers who identify these unclaimed tax benefits during the due diligence phase, or even better, during the crafting of the letter of intent, are well positioned to structure the transaction to take advantage of monetizing these past and future benefits, but they will generally not be required to increase the contract purchase price for the additional benefits they identify. Again, the quantification of these unrecorded assets by the buyer can provide the buyer with added flexibility in structuring either an asset purchase or a stock equity interest purchase of the target. However, special attention to the legal form of the target's business and evaluation of where the refunds and any carryovers reside is critically important in drafting the specific purchase agreement language. The unreported assets will need to be factored into the purchase price allocation on Form 8594 in the case of an asset sale, or IRS Section 338 pursuant to IRC Section 1061. Thank you. This is Eric Fogel of Smith Amundsen. I now turn the presentation over to William Weatherford of Alvarez Marcel, who will discuss the next segment. Thank you.
Thanks, Eric. We can maybe move the slides forward. I'm going to spend the next 10 minutes talking about tax due diligence and some of the considerations that we see there. The items that we review in diligence are really driven by the type of legal entity. So that's why I think we'll start with just going through for the next few minutes the types of legal entities that we review in tax diligence. So we'll start with the limited liability company. This is probably the most common legal entity that we see in diligence, and it's also the most flexible. A LLC can either be a corporation for tax purposes, it can be a partnership for tax purposes, or it can be what we in the tax world call a disregarded entity. And a disregarded entity means that the entity exists for legal purposes as an LLC, but is disregarded for tax purposes and is treated as just an extension of its owner. An LLC can be any number one of these entities. If it is a single member LLC and it hasn't elected to otherwise be a corporation, it's classified as a disregarded entity, like I just said. If it has multiple members and it hasn't otherwise elected to be a corporation, then it's classified as a partnership. And we'll get through what that means to be a partnership or a corporation. Moving on, with respect to the acquisition of a single member LLC, there is an opportunity available for a step up, and in the tax parlance, a step up means that the asset basis gets literally stepped up to fair market value, with the residual going toward Goodwill, as Eric previously explained, that can be amortized over 15 years. A step up is available when a single member LLC is acquired and there's generally no election needed. If a entity is a partnership or a corporation, we'll get to whether and to what extent a step up is available. In terms of diligence, again, it's, as I said earlier, it's really driven by the amount or the type of legal entity that the LLC is. If it's a disregarded entity or a partnership, neither of these types of legal entities are subject to income taxes. So our focus is really on non-income taxes, such as sales and use taxes, property, payroll, and unclaimed property. In addition, there are certain entity level taxes that need to be considered, such as the Washington B&O tax, the Washington commercial activity tax, the New York City unincorporated business tax, non-resident partner withholding to the extent the entity is a partnership. And in addition, there are potential contractual or successor liability issues that we have to review. If the LLC is classified as a corporation, in addition to everything I just stated, we have to review federal and state income taxes. Next slide, please. So moving along the spectrum, we have a partnership. A partnership can either be an actual state law limited or general partnership, or as I said, it could be a limited liability company that has multiple members and hasn't otherwise elected to be a corporation. Partnerships themselves are not subject to any income taxes. Rather, all of the items of gain or loss flow through to the owners, and the owners picked up those income items on their personal returns. However, certain state and local jurisdictions do tax partnerships directly. Again, for instance, Ohio commercial activity tax, Texas, Washington. As I said, the partners are taxed on the income items of a partnership. Any ordinary income items can be subject to tax up to 39.6% for the federal rate. Any capital gain items would be taxed up to 20% plus the 3.8% net investment income tax. And then cash distributions out of a partnership, though, are generally non-taxable, return of capital up to your basis. In terms of acquiring a partnership, you can receive a step up both upon the acquisition and upon the exit from a partnership acquisition. A Section 754 election may be required, and this is an election that you file that basically just tells the IRS, hey, we're going to pretend like we purchased the underlying assets of the partnership. So we'll get into more about when a 754 election is required and when it's not. In terms of diligence focus, similar to single member LLCs that are disregarded, our focus is on the non-income taxes due to the fact that partnerships are not actually subject to income tax. Next slide, please. Moving along the spectrum, we now arrive at S corporations. S corporations are an older type of legal entity, and you still see these quite a bit, although they've somewhat been displaced by LLCs. A S corporation is a pass-through entity similar to a partnership, in that S corporations in general are not subject to entity level taxes, although there are some exceptions. The income items of an S corporation just flow through to the partners. Certain state and local jurisdictions do tax S corporations. directly, for instance, California, Illinois, and Massachusetts. In addition, there can be certain federal taxes that apply to an S corporation, such as the 1374 built-in gains tax. For many reasons, an S corporation is less flexible than an LLC and a partnership. There's no flexibility in terms of allocating profits and losses amongst the shareholders, and there are some very strict, very hyper-technical rules around maintaining your S election, and we'll get into what that means. But the rules are archaic and they're very easy to trip up, which can jeopardize your S election. A step-up is available in acquiring an S corporation. There's a potential for doing a Section 330H10 election or a Section 336E election, which is basically just a liberalized version of the Section 330H10 election. There's also a possibility to do what we call in the field a LLC drop-down transaction, where we convert the S corporation into an LLC in a non-taxable manner. This is useful, for instance, as Eric noted previously, a Section 330H10 election requires a 80% or more acquisition of the S corporation. An LLC drop-down transaction allows you to get a step up with a less than 80% acquisition. In a diligence context, given that the S corporation's non-taxable or nature, or the fact that it doesn't pay any income taxes, hinges on the validity of its S election, we spend a great deal of time diligencing the validity of that election and ensuring that it hasn't been jeopardized. If the S election is invalid, the company is no longer an S corporation, it's a C corporation, and therefore there could be historical income tax liabilities, and a step-up may not be available, although there are ways to structure around that. Assuming the S election is valid, then very much like a partnership or disregarded entity, our focus is on non-income taxes such as sales and use taxes, property taxes, and such, and the other items. Next slide, please. And finally, we arrive at the C corporation, and this is an entity that is a corporation under state law or an LLC that is elected to be taxed as a corporation. It is subject to both income and non-income taxes, and so therefore our diligence is all-encompassing in reviewing everything. Generally, there is no step-up available upon the acquisition of a corporation unless it is acquired out of a consolidated group, or it's otherwise 80% or more owned by a parent corporation, as Eric noted. Next slide, please. Actually, we'll advance too. So now we'll move on to just some overviews of tax diligence. And so in tax diligence, the purpose for undertaking it is that we want to identify any material pre-closing income and non-income tax liabilities that have not been recorded by the seller. Again, all income taxes, both federal and state, and the non-income taxes such as gross receipts, sales use, property, payroll, and then unclaimed property over here at the end. Strictly speaking, unclaimed property, which is situations where you hold property that belongs to others. Classic examples like an uncashed payroll check. It's strictly speaking, it's not a tax, but it's administered by state revenue agencies, so we always review it in the course of tax diligence. The benefit for doing diligence can be, one, identifying unrecorded liabilities, evaluating the potential for a step-up, and assisting in modeling the value of any tax attributes the company might have, such as net operating losses, R&D tax credits, things like that. And then I've listed just a laundry list of other things we'll take part in diligence, such as reviewing transaction deductions, evaluating any goodwill or any amortizable intangibles that are currently running through. Transfer taxes, this is a big one. In situations where actual assets are being acquired, or if there's real estate being acquired, many jurisdictions will impose transfer taxes, and these can be quite significant. So that's something we'll review. And then overall, just purchase agreement review and ensuring that the buyer has appropriate indemnification. Next slide, please. This slide, I think, summarizes most of what I've already covered, so I'm just going to spend a moment on it. But again, the type of the legal entity and the context of the deal really drives the items that are being reviewed in tax diligence. So obviously the classification of the entity, whether it's a C corporation, S corporation, partnership, disregarded entity, that will drive the procedures that we review in tax diligence, the legal structure in terms of how it's organized, its filing status, and the geographical locations, particularly if there's foreign jurisdictions. Often you'll need to engage a team in a local foreign jurisdiction to perform local country tax diligence. Next slide, please. The next couple slides just going into some specifics around certain types of diligence. In a taxable asset purchase, so this is just when you're physically purchasing assets, there's no carryover of any historical income tax liabilities. So generally our focus is on non-income taxes. Again, it's gross receipts, sales, use, property, payroll, and unclaimed property. Transfer taxes is where we'll spend a significant amount of time reviewing, because there can be sales taxes, for instance, review. If there's real property being acquired, most jurisdictions will impose a real property transfer tax or some kind of documentary transfer tax. And these can be significant items. And then the issue comes down to how are these allocated between the buyer and seller. The issue here also in a taxable asset purchase is that there can be additional tax to a seller under an asset sale in a stock sale scenario. So therefore, that also needs to be evaluated. Next slide, please. In a stock sale, for example, or for instance, income taxes, federal and state income tax liabilities do carry over. So in addition to all of the non-income tax items I've listed, we would review income taxes. We'll also do things such as evaluating any tax attributes, such as if the company has NOLs that would be subject to 382. We'll evaluate the availability of those to be used post-acquisition. Next slide, please. With a carve-out of a consolidated group. So this is if you're actually buying a subsidiary out of a consolidated group. For example, an issue we run into a lot is that subsidiaries are liable under the 1502-6 regulations for the liability of the entire consolidated group. So not only are they liable for their own tax liability, they're liable for the entire consolidated group's tax liability. And so therefore, when conducting diligence on a subsidiary of a consolidated group, we end up essentially having to diligence the entire company because we need to understand what liabilities can be inherited. And this often can be somewhat awkward because obviously the sellers don't want to divulge any more information to you than is absolutely necessary. And then you have to, find workarounds, but how you can get comfortable that there are no unrecorded liabilities coming over. And note at the bottom here, there's an opportunity for an H10 election when buying out of a consolidated group. Next slide, please. In S corporation diligence, as I noted earlier, our focus is primarily on the validity of the S election. There are limitations on the number of shareholders, and more importantly, there's limitations on the types of shareholders. It's generally limited to individuals, estates, certain types of trusts, certain retirement plans. The rules, as I said, are archaic and hyper-technical. It's very easy to run afoul of these, which jeopardize the election, and so therefore, we will not only validate this for federal purposes, but various states have their own requirements as well, and we'll have to review that also. And as I said, at the bottom, to the extent an S election is invalid, the company becomes a C corporation and it's subject to income taxes. And finally, with a partnership, the acquisition of a partnership, depending on whether you're buying all of it or less than all of it, will result in a step up. The issue is whether you need to make a 754 election or not. If you're buying the entire partnership and there's no rollover, generally you don't have to do anything. The step up is automatic. If it's less than 100% acquisition, you may need a 754 election. And as I've said earlier, since partnerships aren't subject to tax, generally our focus is just on the non-income taxes. Now I'm going to turn it over to my partner, Dan Rahill.
All right. Thank you very much, Will. Will and Eric, for the last 40 minutes, just went over some very tried and true and well-established, historically established rules with regard to M&A in the tax world. What I'm going to talk about in the next 15 minutes is the unknown tax world, and if we could just go forward a little bit, Eric. Here, I'll just run this over here. Yeah, this is what I feel like if you're looking at your computer screens when I check my Twitter feed in the morning. And in fact, just 2 minutes ago, Donald Trump just fired back at Senator Bob Corker from Tennessee with regard to their ongoing feud, which I'll refer to in a minute. But that all adds to the uncertainty we're going through right now. So let's go through it very quickly. I'm going to try and talk quickly because there's a lot to talk about here. And there's only reason there's a lot to talk about is because I have some editorial comment to add. The framework is very skinny. These are the goals of the Big Six, which is the congressional and administration Republican leaders that put together the framework 2 weeks ago on September 27th that was issued. And the goals were tax relief for the middle class, which you'll see debated every day in the media. Donald Trump's goal of having a postcard tax filing for most Americans. But significant is tax relief for businesses, especially small businesses. And I'll talk about in a minute the reduction in rates for both corporations to 20% and partnership and other flow-through entities to 25%. Any incentives and sending jobs overseas and repatriating money by going to a territorial tax system, and finally broadening our tax base by closing what they call special interest tax breaks. But if you call real estate taxes and state income taxes as itemized deductions, specialized income tax breaks, I think that's stretching the realm of rationale here. Let's just talk about a little bit about the legislative process. Okay, we've got a unified House and Senate here, so one would think, along with the administration, that this would be a little bit easier than it is. But as we know from healthcare reform, or the failure of healthcare reform, this isn't so easy to get passed through. The reason I bring this up is in the Senate, for this not to be a sunset 10-year tax reduction that I'm going to talk about, you need 60 votes. If you don't have 60 votes, then it has to be revenue neutral. Obviously, what's being suggested or put forth right here in the unified framework for fixing our broken tax code is not going to be revenue neutral. Something that Paul Ryan, for the last 2 years, has been calling for revenue neutrality, has stepped off that stump there and is towing the party line with President Trump that this is going to obviously increase the deficit by quite a bit. Let's just talk about the temporary versus the permanent effect of tax cuts. I think this is quite interesting. A temporary tax cut, which will, or temporary legislation in this situation that will only last for 10 years because we cannot get to a 60 vote majority in the Senate, will have this effect on GDP growth. You can see, and this is a slide that I used back when Trump was suggesting a 15% corporate tax rate. It's now 20, but it's directionally correct. And I like this slide because it shows in the red line here, that is the temporary effects on GDP growth of a 10-year tax cut versus vis-a-vis a permanent rate cut in the green and baseline in the blue. And what that means is you'll get, in the first 5 or 6 years, a benefit to our economy from a rate cut. Again, one of the cornerstones of the Republican argument for cutting rates. But then it quickly drops off because of the timing differences that will turn around, and the anticipated increase in rates once a 10-year period expires. So I think that's important to note that the GDP growth here, if this is a temporary rate cut, will not be as significant as originally suggested. Factors affecting tax reform, just real quickly to go through these. On the left side, favorable factors. Obviously, I think both parties in Washington agree the tax code is too complex. We do have unified House, Senate, and executive branch. However, we saw what happened with healthcare reform and the failure to enact that. And movement of bringing repatriation of offshore earnings that have not been taxed in the U.S. back to the U.S. I'll talk about that in a couple minutes. But what is working against it? And if you were handicapping this situation and betting that this would or would not pass by the end of the year, there are obviously winners and losers, and we're starting to see them coming out of the woodwork right now on the Democratic side. Obviously, the increase, the lowest tax bracket for individuals being 12 versus the current 10. Obviously, they say that that's hurting. Obviously, Paul Ryan will come out and say it's broadening the tax base. So we have winners and losers going back. The arguments are starting, lobbying efforts are starting, but the extremely short timeline we have left before the end of the year right now, and the number of congressional days with the holidays coming up, it just would make it seem, to me, in my opinion, almost impossible for them to fill in the blanks, since what we have here is so undefined at the moment. It's too much work to do before the end of the year, I believe, to get this done. But in any event, stranger things have happened, and I've been around 35 years doing tax work, and almost anything is possible here. So let's talk about it. What is the legislative process that I go through and I talk through? Well, obviously, it starts in the House. That's why you see Paul Ryan's name most frequently mentioned with regard to his House blueprint from the summer of 2016. It starts in the House and flows through the Senate. So you're not seeing much Senate discussions at this point. It's mostly Paul Ryan and Representative Brady that are leading the charge. And then it goes to Joint Committee, and then obviously the White House. And then the hard part begins, because the very last step is those poor people in Treasury and the IRS have to actually write the rules and begin implementation of this. Let's just talk a little bit about the details. I hope you can see this. Corporate rate reduction down to 20%. And what I'm showing here on this slide and the next slide is how the unified framework that the gang of six, some call them, proposed 2 weeks ago versus Republican blueprint are almost identical. But we'll see one big change in a minute on the next slide. But let's just go down how they are so similar. And what I have been telling my clients and people that ask is when I don't have an answer, I will go back and I'll take a look at what the House blueprint said as far as details were concerned, because there's much more details, about 38 pages versus 8 pages, and had a little bit more detail in it. Again, not a lot of detail in either document. Limitation on interest expense, partial limitation, what does that mean? We don't know yet under interest deductions. The Republican blueprint had no deduction for net interest expense. CapEx recovery, again, full expensing for assets acquired after 9/27/17 in the unified framework for assets that have been at least 5 years. So that what you're going to be able to do is write off anything 5 years or less, or short-term property or depreciable assets, other than structures or real property. So 39-year or real property, 15-year won't probably qualify for this. But again, the devil is in the details. Other deductions, repealing 199. That's big for domestic companies, and that will be a big revenue raiser. But we are going to retain the R&D credit, which is huge for pharmaceuticals and for the growth, in our economy. Carried interest, didn't mention it. We'll go over that in a minute. Territorial system, yes, we are moving away from our current system of worldwide taxation to a territorial system. We'll go over that, and finally, the business taxation of individuals. The very last line on here is absolutely huge to me. It turns taxation that has been in effect for over 100 years in the United States on its ear. We are now going to apply an entity level tax to partnerships, S corporations, and sole proprietorships. And how we're going to do that? Well, that remains to be seen. A little bit more in a minute. In blue at the bottom, and I'm just going to go quickly here, what is the big difference between the Republican blueprint and the unified framework? In the Republican blueprint, Brady and Ryan wanted revenue neutrality, and they therefore had something called the BAT, or Border Adjustment Tax, you may remember. That went away about 2 months ago. They conceded that will not pass. So that was eliminated in the unified framework. That's why we're looking at such big deficit increases. We don't have enough offsets here to balance the budget and make this balance. That's why we're only looking at a 10-year timeline, most probably. What's the driver in all this? Well, why have we been talking for years about corporate tax rates and why they need to come down? Well, just take a look at this chart, and the red line at the top is the United States. Generally, the most common number I hear used is 39.1% effective tax rate in the United States. Ireland at the bottom is 12.5%. Why do people move their IP overseas and then pay royalties to license back their IP? Why do you set up headquarters overseas? Why does Apple leave money overseas? It's because the U.S. rates, state tax affected is 39.1% versus leaving it overseas and not incurring that big differential that you can see here. That's why we're talking about tax reform, and that's why tax reform would be good for the U.S. economy and make us more competitive on the worldwide stage. A little bit about the details. Some things that people don't think about. We just talked about the 20% flat rate for corporations, C corporations. However, do many of us think about the fact of what that will do to the financial statements of deferred tax assets and liabilities that are on the books? The drop in the tax rate, using a 20% tax rate, for a company like AT&T, has a $60 billion deferred tax liability, mostly due to accelerated depreciation that AT&T has. That means that they have deferred taxes down the road, ultimately because they've accelerated deductions, taken deductions today, but ultimately will be to be paid down the road. The timing difference is $60 billion. Well, under ASC 740, or some of you may refer to it still as FAS 109, accounting for income taxes for GAAP purposes, you measure your deferred tax assets and liabilities using the tax rate that is in effect in the quarter at which you're reporting. And therefore, if there's a law change in a particular quarter, you need to readjust your balance sheet. Well, the pickup to AT&T by a drop in rates from 35% federal only corporate rate to a 20% tax rate is a pickup of $35 billion. What effect would it have on Apple? On financial statement purposes only, $18 billion. Apple's deferred tax liability is primarily the result of offshore earnings that have not been taxed back in the U.S. Now that has to be weighed in a minute with the whole repatriation scheme that we're going to talk about. But just think about the effect on financial statements and what this would mean to DTLs and deferred tax assets. All right. Pass-throughs and sole proprietorships. I frequently tell people when I'm doing this in person, if you can figure this one out and let me know how it works, please let me know. We are going to tax at the entity level, previously referred to as flow-through entities of sole proprietorships, partnerships, and S corporations. That is going to be huge with respect to M&A activity and modeling. So, and the impact down below, and to just throw a fun quote in here, the very last bullet point, services companies that are pass-through will not get the benefit of the rate, said Stephen Mnuchin, our Treasury Secretary, September 12th. What that means is large hedge funds, large law firm partnerships, accounting firm partnerships will not get the benefit of the 25% rate. But again, all the detail we have is this quote and a few similar quotes that he's passed out. I'm going to go real quickly through some of the rest of it. Again, we're going to retain the irony credit and LIFO. They are not being eliminated. NOLs, no discussion of NOLs. However, the House blueprint was going to significantly change NOLs, such as eliminating NOL carrybacks and limiting carry forwards to 90% and making them infinite. So we'll see. We'll see if this at all changes. The one-time repatriation I talked about, here's your one big revenue raiser. Now the bad is gone. We have a generally, the most common number I've seen in many publications is $2.6 trillion offshore right now. At a rate of a cash rate of 8.75%, bringing it back, we generate $228 billion of one-time tax revenue. So that will help in part to offset the deficit that will be created by the rate reduction. I find it also interesting that Donald Trump, in a recent tweet, said he really believes that 2.6 trillion is 3 trillion. I don't really know how he came up with that number, but he said that's money that's been there for years. It wants to come back to this country, but the tax situation didn't allow it to happen, and also the bureaucracy in Washington. Well, this is what they're trying to change. We're trying to go to a territorial system and eliminate that incentive for people to park their money offshore. Proactive steps, again, very quickly, just to go through these. The impact of double taxation is going to be significantly reduced here, obviously with the rate dropping down to 20% for C corporations. Normal tax planning, as we're currently in a 35% tax rate environment for C corps, the age-old adage of accelerate deductions and defer income, and you can see some of the techniques we've been using for forever listed here. Section 199 is going away, so taking advantage of that in its final year. Accelerating, for example, worthless loss deductions, high basis assets, write-offs, et cetera, NOL planning, not really an issue here right now. If the NOLs are still going to be untouched from a tax law point of view, but the fact that you can still get a 35% benefit on carrybacks is important if we go to a 20% tax rate going forward. So you want to maximize your NOL in the current year if you have carryback potential. Just real quickly, I just want to touch on individuals for a second. I know the focus of the talk today is primarily on M&A deals, but to the fact that you're dealing with flow-through entities, individual taxation is very important. You can see now, and we have not, the unified framework has not yet come out with what the brackets are going to be, but they're going to be 12, 25, and 35, down from the 7 brackets we had before. They are reserving the right to have a bracket above 35%, and again, that's being debated every day when you read the Wall Street Journal or the New York Times or the Chicago Tribune. Itemized deductions, everything it gets eliminated except charitable deductions and mortgage interest. We talk about that, tax credits, the child tax credit. We're eliminating the alternative minimum tax, but in effect, by doing away with itemized deductions, except for charitable and mortgage interest, we are in the AMT. So we are eliminating the AMT because we no longer need it, because the new tax system will be an alternative minimum tax system. Essentially, that's what we're going to. And finally, the last one on here, capital gains was not mentioned, and we're going to eliminate the estate tax. But again, not a lot of detail on that. I look back to the Republican blueprint and for a little bit of clarification in that. Again, individual rates dropping, long-term capital gains, no mention. Pass-throughs, huge the fact, and that will change your modeling going forward significantly from an M&A perspective as you model things out. And carried interest at the bottom, I want to say it was not mentioned in the unified framework, which is quite interesting. And finally, individual income tax issues with regard to itemized deductions. The increase in the standard deduction, as you can see here, up to $24,000 for married filing jointly, doubling it essentially, is going to eliminate a lot of potential home buyers out there. Why? Because when a millennial or anyone goes to buy a house, or their first house or the second house, they're factoring the tax deductibility of real estate and property taxes and their mortgage interest. You have now knocked out a huge portion of those potential buyers or current homeowners from receiving the tax benefits of home ownership. Who does that benefit? Well, generally it benefits people who build large, high-rise, tall apartment buildings, but what it also does do is it affects the ability, it will have a great effect on charitable contributions. The charities people will no longer get a tax effect if they fall within that range. A little bit more on itemized deductions. What didn't happen, the 3.8% investment tax in the middle there. That's part of ACA. So that's part of healthcare reform. And since that didn't pass, that remains, and that was not mentioned in here. The proposed repeal of the estate tax, no detail actually in the unified framework 2 weeks ago, but under the House plan from a year and a half ago, Paul Ryan's blueprint, as I call it, held for no estate tax and no capital gain on the time of death, just simply kicking the tax basis can down the road for a closely held company, and that to be a timing difference we realized later on. And my final technical slide here, I just want to mention that there's a word that's being thrown out there called Rothification that's not in this, but you'll see it mentioned and could be mentioned later on as a potential revenue raiser. That's where what could happen is what's been discussed is half of your 401k contributions would be mandatorily Roth 401k contributions going forward. That would be a big current revenue raiser. It's a timing difference. And then obviously you would take your money out tax-free when you retire. And with that, I'm going to thank everybody for listening to the three of us and turn it over to some questions. Will?
Yeah, it looks like we've received some questions. First one for Eric. Where does intellectual property fit into the allocation of purchase price for asset deals?
Thank you, Will. Copyright, licenses, patents, formulas, designs, know-how are considered Class 6 items, general intangibles. The general depreciation period is 15 years with some exceptions based on type of patent and useful life of the patent.
Gotcha. Thank you. Second question is for me. It says, how have the change in the partnership audit rules affected diligence? And that's actually a really good question. So I had said that partnerships don't pay income tax, and that's true now, but starting in January 1, 2018, that's going to change. The Congress back in 2015 changed the audit rules for partnerships. So as the law stands right now, if the IRS audits a partnership and finds a deficiency, the IRS has to go after the individual partners to seek payment of the liability. Starting January 1, 2018, the IRS can assess a partnership directly for any deficiencies. So the diligence of partnerships will become very much like C corporations going forward. I mean, obviously, this is very technical, and there's a lot of things I'm glossing over, but there's going to be more scrutiny of partnerships from a diligence perspective going forward. And finally, we have time for one last question. This one's for Dan. What provisions of proposed tax reform would most affect M&A transactions?
Well, I just think when you're modeling out an M&A transaction, the rate reduction for a C Corp down to 20% is just huge. But much more so, the taxation at 25% of partnerships, including LLCs, S corps, and sole proprietorships. It's really going to, while it may not throw EBITDA upside down because that's earnings before taxes, depreciation, amortization, it will certainly change the way we calculate what our return is going to be on a potential acquisition. So with that, I think we're done, folks. I want to thank everybody for indulging and sitting on the phone and listening to us pontificate on the future of tax reform and what current law is. I want to thank my colleagues, Eric and Will. I think they did a great job, and I want to thank you all. Appreciate it.
Yes, thank you all. And again, this webinar was recorded and will be posted on acg.org's webinar content library. Have a great day.